Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views.
Hey, good morning. Welcome to Wednesday, 14th of September 2022. We swapped the beach of Southern California for back in the mountains in Utah. We're back in Park City. All right, yesterday was an interesting day. Futures this morning were a little bit green. They've gone a little bit red. Now they're back a little bit green. Let's call them flat. So given what happened yesterday, and I thought it made sense to just go over the math we put out there a couple weeks ago on risk testing the S&P 500. Real simple stuff. Taking a look at the potential of a recession, we used Eddie Ardeni's got 215 in earnings per share for the S&P for 2022. We borrowed his 215. He's a much more accomplished economist than I am. And just to put average multiples and average pullbacks in there. So we took that 215 in earnings. We assumed a garden variety 26% reduction in earnings from peak to trough. On those trough earnings we arrived at, we put an 18.5 multiple on there. That's the average multiple for trough earnings of the past several recessions. The average we came out, and the number we came out at was just under 3,000 for the S&P. Now, this doesn't, the garden variety 26% pullback does not include 2008 and 9, where we saw a 57% pullback. So if this thing turns out to be more severe than is expected at this point, then that 3,000 could also be potentially in jeopardy just on that basic math. And you've heard a lot of other people come up with a number like that, so that number is not that hard to arrive at. Jeff Gundlach was the most recent one to join that camp yesterday at Future Proof. Dan Niles has been at 3,000 for quite a while now, and Scott Minerd, as we all know, a couple weeks ago put out that 3,000 number as well. Gundlach also seemed to endorse Minerd's timing for this by the end of October. So this could be potentially quick and potentially painful. I guess the good news is it would be over fast. So what to do? Hopefully it's. I assume right now you don't have a whole bunch of ARC names on, but just in terms of us, we've got large pharma, high quality biotech right at the top of our holdings list. It's been there all year long. I still think med device can work from here. We're using the IHI to do so. Another one to maybe take a look at is Becton Dickinson. Cheap. They've got a lot of new innovations coming up in their portfolio of products. Looks interesting. Not a big reach necessarily there. Obviously a defensive business. And then we have been talking a bit about this for a while to stay away from cyclicals. Semis, industrials, what have you. Consumers, even consumer discretionary. Although I will say that thus far, I think, like Moynihan talked about it the other day, that the consumer is holding up really well, spending, and yeah, I would attest to that. Everywhere I go, restaurants are full. The consumer is, if there's a recession coming, no one has told the consumer yet, because they're still out there doing their thing. But to take a look at cyclicals, have them on the radar, obviously, because if we do go down that fast, that far, it'll be time to put those on the sheets in terms of adding them on. Honeywell and Emerson are two of our favorites. We'll talk more about those as it becomes relevant in terms of timing. We'll likely be adding to our inverse ETFs. We did so yesterday at the open on NASDAQ and S&P. We'll probably take up long vol as well. Other defensive that can work: Walmart, Dollar General, Costco. We own Costco. We might we owned Dollar General in the past. They actually recently had a pretty good quarter. So in terms of execution and fundamentals, they've been de-risked recently. Relative outperformers can include infrastructure bill beneficiaries. So you want to take a look potentially at solar names, engineering and construction. Quanta Services is one of our favorites. PWR is the ticker. And you could probably take a look at munis if that's something that you do. They've gotten pretty beat up, and I think munis now are yielding more than high yield yielded like 6 months ago. So that could be interesting. Long-term treasuries may also recoup their flight to safety status. We own the TLT. It's not happening yet, but we do own a decent amount, and if it starts to go, that could be interesting. And then just this whole rail thing, worker strike, just be aware that's going to have a negative impact on commodities if that's not that obvious on the near term. So just kind of an FYI when you look at some of your names and you're like, why is Peabody going down 8%? That could be why. All right, that is it. Have an awesome day, and we'll be back to you tomorrow.
Some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.